Hi, everyone. How are you? Hope you are well. So, today we're going to talk about a strategy that most people don't talk about when it comes to buying a home. And the reason being is that the lender doesn't get paid when you use this strategy. So, that's why it's not commonly heard. But this is the assumable mortgage. So, what is an assumable mortgage? So, assumable mortgage is you, as the buyer, you're taking over the seller's loan. That's what it is in a nutshell. So, what is the benefit of doing an assumable mortgage? Well, the seller, they bought the house like a long time ago. They didn't buy it in 2023. They bought it a long time ago. Therefore, they have a low interest rate. So, there used to be a point in time where the interest rates were 2%. And this was about 7 years ago. The interest rates were about 2%. So, say if you buy a home from a seller who they had their house 7 years ago. So they're paying a 2% interest, where the interest rates now are well over 2%, as I'm sure you are aware of. So the benefit of an assumable mortgage is, because you're buying this house from this seller who got the house 7 years ago with a 2% interest rate. When you take over that loan, your interest rate is going to be 2% in comparison to other people who don't do this strategy, and they are paying the high interest rates that we have now. So that is the benefit of doing the assumable mortgage. Lower interest rates. It also, you have lower closing costs when you do this strategy. So assumable mortgages are loans that are, the FHA loan is assumable, the USDA loan is assumable, and the VA loan is assumable. So if the seller has any of these three types of loans, they have an assumable mortgage. Now, the seller may not be aware that they have an assumable mortgage, but if you can just identify one of those three loans that I mentioned, it's assumable: FHA, USDA, VA. So the seller has to initiate the process with the mortgage company. So the seller is the one that has to call the mortgage company and have the mortgage company send them this assumable paperwork. So the seller fills this paperwork out and sends it back to the mortgage company. And then the mortgage company makes sure that the buyer qualifies. So the mortgage company is still involved in this process. They're still making sure that the buyer qualifies. So they're not completely out of the picture. They're still in the picture. This paperwork work is done through the mortgage company, and they are still checking to make sure that the buyer qualifies. However, the seller has to initiate this process, call the mortgage company, get those assumable paperwork sent over to the seller. The seller fills it out, sends it back to the mortgage company. Then the mortgage company checks in with the buyer to make sure that the buyer qualifies. So I'm going to give you an example. Say that you are purchasing a home that costs $186,000. Okay. Say that the seller owes $144,000. So, for example, you, as the buyer, you go to this seller and you're responsible for what they owe on the home. They owe 144,000. So you're taking over their loan. You're taking over what they owe. They owe 144,000. So you are assuming the amount owed. However, you do have to put down a payment, and that payment is the equity, however much equity they have in the home. So they bought it for 186,000. They owe 144,000. You assume the loan for the 144,000, but you subtract 186,000 minus 144,000, and that's how much money you have to put down. That is the equity. The value of the home, the price that they bought the home for, minus how much they owe is the equity, and that is how much you have to put down. So in this instance, with this $186,000 home, you would take 186,000 minus the 144,000, and then you would be putting down 42,000. So what is the benefit of this assumable mortgage if the mortgage company is still in the picture? Well, the benefit is the lower interest rate and the lower closing costs. So why is a lower interest rate important? The lower interest rate, the lower the interest rate, the lower your monthly payments would be. And so that is the bottom line to the assumable mortgage. Again, the mortgage company is still involved. They're still making sure that you qualify. However, when and if you use this strategy, you'll be paying a lower interest rate, which translates into a lower monthly payment. So, a lot of times people are not aware that they have assumable mortgages. So, it's just important to ask. You can ask if it's an assumable mortgage. You can ask the realtor if they have an assumable mortgage. The realtor will have to get to the seller and ask the seller, is it an assumable mortgage? And then the seller probably is not aware if it's assumable or not. But again, if it is one of those three types of loans, then it is assumable. And again, that is the FHA loan, the USDA loan, and the VA loan. All right. So this is Love and Money Show. If you like the show, please hit the like button. It helps the channel. Please hit subscribe if you're not a subscriber, and the notification bell next to it so that you won't miss an episode. Also, please leave a comment and let me know your thoughts. Thank you for watching and have a good rest of your nights.